Hello and welcome to DeepMacro's The Future of Finance podcast. I'm Jeff Young, CEO and co-founder of DeepMacro. With me today is Bill Dudley. Bill was the president of the Federal Reserve Bank of New York and vice chairman of the FOMC from 2009 to 2018. He's currently the chair of the Bretton Woods Committee, is a member of the Group of 30, and a senior research scholar at the Griswold Center for Economic Policy Studies at Princeton. Let's jump right in, Bill, and I'd like to start with inflation. What do you think have been the primary drivers of the inflation surge? And realistically, do you think we could have seen it coming any better?
Well, I think there's a number of things that are driving inflation. That's why I don't really subscribe to the transitory camp or the non-transitory camp. I think there's elements of both. The first thing that happened was in the pandemic, there was a big shift in the composition of demand away from goods, away from services to goods, because you couldn't go out, you couldn't travel. So people bought a lot more goods than they typically did, and that put a lot of pressure on supply chains. And that's why we saw a big increase in goods prices. So that's number one. Number two, we had good productivity growth for a while, the early phases of the pandemic, but we've had absolutely horrible productivity growth over the last year. And so that's also been a contributor to inflation. Number three, fiscal policy was very expansive, both during the Trump administration and the Biden administration. So a lot of transfers to households and businesses. So when the economy opened up, people had lots of money to spend, and they spent it. And so the fiscal policy stimulus was an important factor. And then finally, the Fed kept monetary policy too easy for too long, and we sort of know that because when the Fed tightened 75 basis points 4 meetings in a row, that's essentially a mission that they've been very late in terms of removing monetary policy accommodation. So some of this you could chalk up to difficult to forecast how things are going to be coming out of a pandemic. But you could also argue that the stimulus on both the fiscal and monetary policy side was kept in place much too long. Once the vaccines were introduced, it was pretty obvious that the economy was going to go back, to a more normal footing. I think that was the time to start to remove monetary policy accommodation.
Okay, interesting. I see that you didn't list global factors in this other than, say, the pandemic.
Well,
Sometimes we hear it's global, so it really isn't kind of our fault, let's say.
Well, Ukraine-Russian war was obviously another shock that to sort of exacerbated the supply chain disruptions. Energy prices went higher, went higher. So, but I mean, we already had a lot of inflation before the Ukraine-Russian war.
Okay, very good. So then, if we kind of take a step back, a lot of times people compare what's going on right now with the last time that we had a really kind of high level of inflation in, say, the 1960s and 1970s. Do you see any similarities, any differences? Is it a relevant model, or is it just a completely irrelevant comparison?
I think it's not that relevant, because what happened in the 60s and 70s were generated by different forces. But there are some parallels. Number one, fiscal policy was very expansive in the late 60s and early 70s. Under LBJ, we had the Great Society programs and Vietnam War spending. And number two, monetary policy was kept too easy for too long. We also had wage price controls that temporarily subdued inflation pressures, but obviously all it did was also distort economic activity. So I think there's some similarities and there's some differences. History doesn't repeat, but it rhymes, and there are some things that are similar this time.
Okay, I'll ask a little bit of a technical question. In 2020, the Fed adopted a new monetary policy framework. I think it's usually called flexible average inflation targeting. That was announced in August. I wonder if you could give us a little bit of background about why the Fed adopted it. Does that have anything to do with the sort of low for longer psychology, or was it just really bad timing?
Well, the reason why the Fed introduced a 2% average inflation targeting regime was because if you remember back in the last cycle, the Fed was having trouble pushing inflation up to 2%. And as a consequence of the Fed's persistent shortfalls of inflation relative to the 2% target, inflation expectations were starting to become a little bit unanchored to the downside. Not dramatic, but a little bit unanchored to the downside. And this caused the Fed to start to worry about the Japanese type situation, where you don't have, short-term rates aren't very high. You don't have much room to cut rates in a recession. You get pinned at the zero lower bound for interest rates. Inflation keeps falling. Monetary policy gets tighter, and you just can't get out of that situation. So the Fed basically said, look, we need a regime that doesn't target 2% inflation at any particular point in time, but targets 2% inflation on average. So misses to the downside will be offset by misses to the upside. Misses to the upside will be offset by misses to the downside. And that way people will know that inflation expectations should stay well anchored at 2% because we're going to offset those misses. I think all that was completely sensible and a reasonable response. The problem was how they operationalized it. The Fed operationalized it by basically saying, we're not going to raise rates until we get to 2% inflation, full employment, and we're confident inflation is going to get to go above 2% for some time in the future. So that means that rates are at zero, even as the economy is beginning to start to overheat. They exacerbated that further by basically saying we can't raise rates until we finish asset purchases, and we can't just end asset purchases. We have to taper asset purchases. And we can't just taper asset purchases. We have to talk about tapering asset purchases before we actually begin to taper. So all these things stretched out the process by which the Fed would actually begin to raise short-term interest rates. And that's really, I think the Fed was probably 6 to 9 months too late. In my mind, once the vaccines were introduced, it was pretty obvious that the economy was going to reopen again. That was probably the time to end the quantitative easing. And then once quantitative easing was over, you had a pretty clear sailing for when you wanted to actually start to lift off.
Okay, right. So there was actually a lot of inflexibility built into the flexible targeting, it sounds like, by the requirements. Yeah. Okay.
They're sort of fighting the last war. I mean, the last war was about inflation was too low. We didn't realize we had that much room in the labor market. So let's let things run. And it turned out that that was not really very suited to the current environment.
Okay, great. I wanted to ask about political pressure. When President Trump was bashing the Fed, I always thought it was it's kind of easy to brush it off and to take the high ground that, the Fed is independent and to ignore that. But what about the overall environment in which the Fed or any central bank operates? It seemed like there was a pretty common view that it's better to do too much than to do too little. And that seems to have contributed to the too easy for too long, at least that's what I was thinking. I wonder if you could kind of tell us more about the more subtle ways that, if it's not political influence, but let's just say outside influences tend to operate inside central banks, not just the Fed either.
I would say, at least in talking about the United States, which is what my experience, I think the political pressures are very, very modest. I mean, we didn't talk about the political situation at all when we were talking about monetary policy in the 11.5 years I was sitting at the FOMC table. I think that there's a lot of publicity about that pressure, a lot of press about that pressure, but I think the Fed basically view is, end of the day, Congress has set the mandates for the Fed: price stability, maximum sustainable employment. Our job is to try to carry out those two mandates, and that's what they try to do. They don't try to, tack one way or the other just because a particular party's in power. And the Federal Reserve is set up in a way to insulate the Fed from political pressure because the Board of Governors terms are 14 years long, and the presidents can serve for 10 years or until they get to 65 years old. So you have positions that don't turn over that frequently.
Right. Okay. You mentioned the 75 basis point moves that the Fed started from, I think, June. Can you give us some insight into how the Fed sizes its moves? We have been used to 25s, and then I think we got 1 or 2 50s, and suddenly 75s. But how is this done?
I think it's all about, number one, where are they versus where they should be, and number two, what's the data telling them? So I think basically two things happened this year. Number one, they were very far away from where they needed to be. So they were at zero in early March, and at the time the economy was basically already at full employment, and inflation was running above the Fed's 2% objective. And number two, the subsequent information that they received from March told them that inflation was much more persistent, and there was much less slack in the labor market than they thought. So part of the 75 basis point series was to catch up, but part of it was also that the new information is telling us that we also need to do more.
Okay. Then one of the arguments that sometimes I hear against large, let's say, supersized rate hikes is financial system, that maybe it's better to take your medicine up front from a cyclical inflation point of view, but if you do too much too quickly, it could really hurt the financial system. I wondered if you think that we have better information about potential financial system risks now than when we did, say, when you joined the Fed, which was kind of in a pretty systemically important period of time?
I think we have somewhat better information because the Fed is much more focused on financial stability than they were prior to the great financial crisis. I mean, they have a whole group now that just focuses on financial stability. And twice a year, they publish a financial stability report giving their assessment of risk. So I think that's a positive. But I think the bigger positive is all the things that were done post the great financial crisis to make this financial system more robust. When you think about the banking system, more capital, higher quality capital, stress testing, liquidity requirements, a focus on good governance, a focus on good data, people looking at the validity of the models that are used. So, the core banking system is much more secure today than it was, 15 years ago.
Okay, and so maybe fingers crossed, but you feel that the systemic risks right now are, we've had a big increase of interest rates, but systemic risks are such that they're low enough that the Fed can keep doing pretty much whatever it needs to do on the inflation side.
Well, you certainly worry about whenever you're raising rates this fast that somebody's going to be caught out, and that's going to create some financial instability. I think the interesting thing in this current situation is we haven't seen any of that. I mean,
Right.
the UK had a lot of problems as they had a big uptick in gilt yields, which then contributed to lots of problems in terms of their pension system. But in the United States, we have seen very little consequence of the Fed raising rates this quickly. So, it doesn't mean that problems won't arise, but so far so good. I mean, the biggest area of problems that we see, in terms of financial stability on a global basis is not in the traditional finance sector. It's in DeFi and what's happening in the crypto ecosystem.
Yeah, I mean, I'd really love to hear your thoughts on that if you have anything to say about that, just because it has become so dramatic in the last couple days, really, or hours, almost.
Well, yeah, it reminds me a little bit of the great financial crisis in the sense that, you think about the great financial crisis, it was based on a belief system that turned out to be false. National home prices can never decline. Subprime lending is safe. AAA rated CDOs are safe. And those all turned out to be wrong. And I think, what's happening in the crypto ecosystem is that you have these tokens that were sustained basically by belief. And as long as activity was increasing, that was supporting the value of these tokens. And so it was making everybody comfortable that this thing could just keep going. As soon as you start to see, sort of chinks in the armor and entities start to fail, the whole thing starts to run in reverse. People start to say, well, maybe these tokens aren't really worth what I thought they were. The values decline. That puts stress on the issuing entities. And next thing you know, parts of the crypto ecosystem are starting to fail. So my own view is that nothing that surprising about what we're seeing. It's probably got a considerable ways to go, because every time someone fails, that places lost on other players in the ecosystem, so it weakens other players. And every time someone fails, that reduces trust in the system, and that also then dampens activity, reduces revenue and profits. And so, the downturn tends to keep going. And in some ways, it's more dangerous for itself, in the sense that there's no lender of last resort here. There's no Federal Reserve that's going to come along and introduce special liquidity facilities. The Fed's not going to cut interest rates because of what's happening in the crypto space. The crypto system is, it's big, but it's not big enough to be economically systemic from the Federal Reserve's perspective. And as a consequence, because it's not big enough to be systemically important, no one's going to come along and rescue it. The other thing I'll say that's going to happen is we're going to see more regulation. Just like the great financial crisis led to a lot more regulation for the traditional financial system, I think we're finally going to see movement on regulating a lot of these entities a lot more closely.
Okay, great. Thank you very much. So returning to monetary policy now, the markets, at least temporarily, have been looking for a pivot, so to speak, basically since the Fed started hiking rates. Do you think, and now it's building because rates are much higher, do you think that markets are still too optimistic, or are we really getting closer?
Well, I think we are getting close to the Fed doing smaller rate hikes. I mean, they
Mm.
basically communicate that's their desire. They want to do it that way because they're worried about the long legs of monetary policy, and because of those long legs, they might not recognize the full consequences of what they've already accomplished. Where I would disagree with markets a bit is I think that the Fed is going to keep rates not so much ever higher. I think they're going to rates are probably going to peak around 5% to 5.5%. And the precise peak really depends on when the data starts to allow the Fed to stop hiking altogether. Where I would disagree with the market is this notion that the Fed is going to reverse course quickly and take rates back down. I mean, as Powell talked about in his last press conference, there's a lot of time that has to pass. First, you had tighten monetary policy, then it tightens financial conditions. Then financial conditions slow down economic growth. Then the slowdown in economic growth generates slack in the labor market, which pulls down wages. And finally, that brings inflation down. That takes time. And so far, the Fed hasn't really accomplished much in terms of slowing the economy down. I mean, the economy actually looks like it's going to be growing faster, much faster in the second half of the year than it was in the first half, when it actually contracted a little bit. The Fed has not generated any meaningful increase in slack in the U.S. labor market. So, in my mind, yes, monetary policy has gotten tight. We're starting to get to a tight monetary policy setting, and it's tightened financial conditions. But the other links in that causality haven't really happened yet. And so I think rates are going to stay higher for longer than what people expect.
Okay, that's interesting. So kind of the stop and go pattern of the 1970s is probably pretty much in the mind, and the idea that there are lags and we need to kind of really wring it out of the system. Then in terms of where we go back to, I think a common view in the market is, well, now we kind of buy that inflation has peaked, it's going to be coming down, but it's certainly going to be difficult, if not impossible, to get it back to 2% like, before the pandemic. Do you think that 2% is still doable and the appropriate target that most central banks have converged on?
So I think it's definitely doable. It's completely up to the central bank if they want to, impose enough, stringency on the economy to slow it down sufficiently. You can definitely get back to 2%. And I think Powell is determined to do that. Whether he can bring the rest of the FOMC along with him on that journey will be interesting to see, because obviously right now everyone's united. Inflation is the big enemy. We haven't really paid the cost yet in terms of a higher unemployment rate and layoffs. And as that cost becomes more apparent, there may be people on the FOMC who become less willing to go on this journey. I think at the end of the day, the only thing I would say about where the Fed's headed, they're not. I don't think they're really headed for 2% average inflation anymore. I think it's basically when inflation is above 2%, we try to go back to 2%. We don't try to go below 2% to offset errors on the upside. When inflation is below 2%, we try to offset that because we don't want inflation expectations to be anchored to the downside. So there's sort of this asymmetry. Bygones, when you miss on the upside, just try to go back to 2%. On the downside, you try to actually offset it so you keep inflation expectations well anchored. In terms of the 2% inflation target, they can't change it now, because that'd be like moving the goalpost because you can't actually succeed, and that would just be credibility destroying. There will be some discussion, I guess, later about whether they should raise the target to a higher number, but I'm not sure that the case for doing that is quite as compelling as it was, even a couple of years ago, because short-term rates are going to peak at 5.5% this cycle. That means that there's plenty of room for the Federal Reserve to cut rates when ultimately it's faced with the next recession. This is not, a case like last cycle where short-term rates are peaking around 2%. And there's not much room to make monetary policy more stimulative. This time, there's going to be quite a bit of room. And so, the argument for raising the inflation target is really about generating more room to ease when you're at the end of the business cycle and you fall into recession. So I think it's probably not going to happen. And lastly, Congress sets the mandate for the Fed, and they've said it's price stability. The Fed stretched that a little bit to 2% inflation. I think stretching it to 3% inflation is probably a bridge too far. So my personal view is, this will be examined and discussed. It's taken the Fed a long time to get inflation expectations well pinned at 2%. I'd be surprised if they move away from that.
Okay. Let me talk about a kind of an upside risk on the economy and I guess by extension inflation. And I want to talk about China just for a second, because I think we've gotten so used to China zero COVID or supply side issues. If China really does meaningfully ease COVID zero policy, if they take their foot off the neck of the real estate sector and maybe tech sector, if in relations with the U.S. and other trading partners improve, which perhaps they might be moving in that direction. Do you think we could see kind of meaningfully stronger global economic growth that would also sort of prop up inflation pressures and just kind of lead to another round of this? Is this a high risk, medium risk, something we'll just have to wait and see on? Because it just seems like it's been so long since we've had a really robustly growing China.
Yeah, yeah. I mean, I think it's certainly a risk because China's a big enough economy now that if they go back to, say 5 to 6% growth, that has real weight in the global economy. I guess I'm not, that concerned about that particular risk because it doesn't look like the zero COVID policy is going to be just scrapped. It looks like there's going to be a sort of a long transition from that. And apparently, as I understand the problem, part of the problem is that a lot of this elderly in China have not been vaccinated, and the vaccines that the Chinese have been using haven't been as effective as the mRNA vaccines that are predominant in the United States, and they don't have a tremendously deep healthcare infrastructure to accommodate a lot of people who might get sick from COVID. So I'm guessing this is going to be like a gradual retreat from zero COVID policy rather than a rapid retreat. Better vaccines, more vaccinations, and then once that happens, then you can start to relax things a bit. But it is, the other thing I would just say is a lot of the rest of the world is going to be going in the opposite direction. I mean, I think Europe is going to go into recession well before the United States because the energy shock for them is much more substantial because natural gas prices are a multiple of what natural gas prices are in the U.S. The U.S. is somewhat insulated from the Ukraine-Russia war shock because we produce a lot of food and we produce a lot of energy. And so when food and energy prices go up, that actually in some ways sort of stimulates our economy. Output in the Permian oil basin is increasing now because of higher oil prices. Europe doesn't have that sort of offset. So I think, the European economy, I think, is going to be particularly weak. And that's the same mass of China. So I think that would offset whatever happening in China. I think the U.S. economy is going to be the one that holds up the best, which is sort of good news and bad news. Good news because you obviously don't want to see the economy do poorly, but bad news because the Fed actually wants to see slower growth. They want to see a rise in the unemployment rate. They want to see more slack in the U.S. economy. So I think there's going to be a lot of persistence in the U.S. I mean, one aspect of that is just it's very hard to get nominal GDP growth from 7% down to 3%, which is what they need to do. And a good example of this is Social Security benefits. In January, 70 million Americans are going to get 8.7% cost of living increase. Well, they're going to go. A lot of these people are going to go out and spend that, and that's just going to keep the economy rolling along for a while. So I think there is some persistence that's just going to make the Fed's job more difficult, which is why when we were talking earlier about Fed policy, I think that they're going to have to keep rates at a relatively high level for longer than what people anticipate.
Okay, great. Then finally, Bill, just wanted to ask, I mean, I think it's fair to say that markets pretty much obsess about central banks. They look at everything they say. There's a profession of Fed watchers, and you've spent a long time in both the markets and at the Fed. And so I wanted to ask if there's one thing, what do you think is the one thing that markets get wrong about how central banks operate?
Well, I think what they get wrong, the most important thing they get wrong is the idea that the Fed knows all this stuff that the markets don't know. The Fed knows, like things in detail to the second decimal point, the third decimal point, because they have, 200 PhD economists sitting down in Washington and a bunch of PhD economists that spread across the 12 different reserve banks. But that doesn't typically lead to dramatically better economic forecast, dramatically better understanding of how the world is working. The Fed, has got it wrong over the last year in terms of the economic outlook. They were way too confident there was slack in the U.S. labor market that didn't materialize. Labor force participation rate, did not come bouncing back. They were surprised by the sharp decline in productivity growth, and they were surprised that the inflation pressures were so persistent. So this idea that the Fed knows all this stuff that markets don't know, I think is mostly incorrect.
Okay. Well, I hope then that they can learn from their mistakes. That and that
Oh, they
next time
are.
will be better. Yeah.
Oh, they are. I mean, that's why they did 75 basis points
Right.
4 times in a row. I mean, when I tell market participants about the Fed is really two things. You need to you need to ask yourself two questions about the Fed. Number one, what's their reaction function? In other words, how do they react to a given set of economic data? How concerned are they about inflation versus unemployment? What is the weight that they put on those two things? And second, how are they interpreting the economic data? And how does that economic data flow influence their economic outlook? You can never tell for sure is someone, writing down in their summary of economic projections a given interest rate path because they're they have a different reaction function or they have a different economic forecast. So I always think, when you're listening to Fed speakers, you need to sort of try to distinguish that. The other thing I would just say, some Fed speakers are more important than others. Jay Powell is a lot more important than anybody else. And then after him, I would put John Williams and Lael Brainerd. John Williams is the vice chair of the FOMC, and Lael Brainerd is the vice chair of the Board of Governors. And the reason why those two people are so important is that they work closely with Chair Powell in crafting the agenda for each FOMC meeting. And the agenda doesn't mean the agenda does not mean that these three will necessarily get their way. But boy, having control of the agenda has a lot to do with outcomes. As anybody knows who's chaired meetings.
Right. Okay. Great. Well, Bill, thank you very much. It's really interesting to hear your insights, very concisely stated, and I hope you're right that we're coming to the end of this. I think a lot of people in the market would be relieved. Thanks very much. Okay.
Content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this material constitutes a solicitation, recommendation, endorsement, or offer by DeepMacro Incorporated or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction. All content is information of a general nature and does not address the circumstances of any particular individual or entity. None of the information constitutes professional and/or financial advice, nor does any of the information constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. There are risks associated with investing. Loss of principal is possible. Some high-risk investments may use leverage, which will accentuate gains and losses of securities or firms. Past investment performance is not a guarantee or predictor of future investment performance.